What is the mega trend at play in commercial services, and why is it particularly attractive within the lower middle market?
Two reasons. One, it's a large segment, right? And you've got a lot of lower middle market businesses that are regional. They haven't expanded. And it does connect to some extent to the BPO piece, where more and more facilities and more large retail chains, hospitality, are looking to outsource commercial services, whether that's HVAC or whether that's facilities management. It's not an easy space, so that's kind of nice, right?
Search Party is sponsored by Avidbank, Boulay, Mayer Brown, and Plexus Capital. The lead sponsor is Next Coast Legacy. Hello and welcome to Search Party. I'm David Snow, your host. And today we're joined by Conor Tidgwell of Avidbank, Dustin Sellers and Anthony Walker, both of Next Coast Legacy, a leading ETA investment firm. Gentlemen, welcome to Search Party today. I'm really excited to be talking to you today.
Great to be here.
Glad to be here.
So given the combined network of both Next Coast Legacy and Avidbank, you guys have a very authoritative view of the lower middle market in the United States, particularly in mergers and acquisitions. So I think it's going to be really fascinating to hear you exchange notes about what you're seeing in certain key economic sectors. The sectors we're going to be talking about today are three: business process outsourcing, commercial services, and software. And we all agree that the lower middle market is a very attractive place to do deals, in part because of lower valuations, and also in part because of the significant opportunity to make operational improvements in those kinds of businesses. Well, why don't we start in business process outsourcing? That is a sector that Next Coast Legacy has been active in. Anthony Walker, how do you define business process outsourcing? And can you give us an overview as to what you've seen by way of deal flow in that sector?
So business process outsourcing, or BPO, is effectively the outsourcing of a kind of critical service by an existing business to a third party. And so you can think about kind of marketing, payroll, HR services, customer services, outsourced accounting and finance, all fitting it within kind of that broader BPO or business process outsourcing kind of industry. Why we like it, fundamentally, one of the reasons that companies outsource these types of services is that it is critical to their operations, but it is not core to what they do, right? And so you think about a manufacturing company that is focused on the provision of goods and services and the creation of those goods and services. That's an important part of their business model, but payroll, finance is outside of their core competency, right? It has to happen, but they're not necessarily the best equipped to really be able to focus on that. Or from a size perspective, they may not be large enough to really be able to support the kind of fully built out team required to do that well. And so there's a large opportunity, and it's a very large market that exists for companies that do have that as a core competency to come in and provide that service to a broader distribution of companies within an ecosystem.
For the lower middle market, BPO has been slow to come, but now it's a mega trend. We'll talk more about software later, but technology has enabled a lot of businesses that historically would not have thought about outsourcing a lot of different services, now being able to outsource their customer service, their lead gen, their CRM, their accounts receivable maintenance, you name it. We think that that's a mega trend that's just going to keep going, and it's a perfect lower middle market play.
Probably the most frequent or common BPO is outsourced accounting, bookkeeping. And to Anthony's point, I start with just how critical that function is, especially in the lower middle market. We think about search, oftentimes these are owner-founder led businesses. They're not overly sophisticated. They don't have a robust accounting function leading into close. So it's a fairly heavy lift. We actually interact with a lot of these outsourced accounting firms on a monthly basis. They're akin to an internal FTE controller. That's probably the most common one we see. It's probably the top 2 or 3 most concentrated industry within our entire portfolio.
I talked to a lot of searchers, Anthony, that talk a lot about, well, gosh, from asymptotically speaking, isn't this space been just kind of trod upon? Isn't it kind of over? You've got the Intuits of the world, and you've got a lot of fintech pushing into this space. And every single time I'm like, absolutely not. The vertical specialization, I'm thinking of Charter Impact, Anthony, maybe you can talk about that. The vertical specialization and the uniqueness of accounting by industry and the compliance requirements and the reporting requirements. This is just getting going, to be very honest. And what's really happened is the megatrend has allowed SME owners to embrace outsourced accounting, where before they thought they had to be the one or their spouse was the one that was doing QuickBooks.
Charter Impact was a great example of that, Dustin. Outsourcing kind of in finance specifically for charter schools, which has some uniqueness, some elements of that particular form of accounting that reduces the risk of competitors. There is also a little bit of a barrier that is presented within that industry based on size of company, right? If you are a Fortune 500 company, you have a very large balance sheet and P&L to be able to support a wide number of internal resources to provide that service, whereas a $1 to $2 million EBITDA business doesn't really have that depth of resource. There has to be a focus on understanding what the differentiation is of that particular business that is a BPO provider that provides a moat around the opportunity.
And I would argue, just to put a finer point on that, that the BPO space for HR, really around payroll and likes, there is quite a bit of overdone there in the lower middle market. There is quite a bit of commoditization and lack of differentiation. And you do have quite a bit of middle market and upper private equity really leaning into that space. Whereas on the tax and accounting side, kind of low tech, fintech, there's still quite a bit of opportunity.
Conor, Anthony mentioned a moat as being an attractive characteristic of these businesses. Is that something that as a lender you look at, and sort of how do you quantify that, or how do you perform due diligence on the safety of that moat?
We're looking for a fragmented customer base covering a wide array of industries. Sometimes we'll see these outsourced accounting and they're focused on whether it's all early stage or it's on a certain sector. That gives us some pause. That could lead to potential high churn. The length of tenure with these customers, this the monthly recurring bookkeeping combined with, high gross retention, that's a really strong profile. Or are these more short-term accounting projects that they're constantly having to replenish? That's probably a different story.
Anthony, I'd love your thoughts, because I do see searchers getting kind of caught up in the moat of IP versus unique service experience. And I've found, having, kind of cobbled together a number of different enterprise solutions and the likes to create our value proposition of pro service. We didn't really have any proprietary IP, but that didn't matter because it was the overall experience that mattered. A lot of searchers are like, well, what is unique there? It's off the shelf technology cobbled together. Are we really going to have, higher churn in the future? My perspective is no, if in fact there is something unique about the service offering that's being provided.
Retention is probably the best marker of the criticality of a business. Assuming that you have customers that remain with you for long periods of time, they do not churn, and they actually purchase more of your service over time as they grow, that is a really good marker of criticality to a company. Is it easy to rip out the service that you're providing? The second is margin profile. And one of the things that we consistently see is that businesses that have EBITDA margins in excess of 15 to 20% have more pricing power, which is a circular loop back to criticality of business or service. At some level of pricing, are your customers willing to go out to the marketplace and try to replace you because the value that you're offering is not commensurate with the price that you're charging? And below that threshold, you start to see higher churn figures, more specifically in excess of, let's call it 90% on a gross revenue retention basis. And you start to see dilution of margin as the business grows. That is a really, really, really important red flag and warning sign for searchers to pay attention to as they're going through the course of diligence. Because a lot of these businesses in the BPO space are doing and providing a very similar service to competitors. But the markers of differentiation come in the margin profile, they come in the retention figures, and importantly on the gross margin line. If you're in excess of 50%, it's a really good marker that as the business continues to scale, more of that profitability will flow through to the bottom line and accrete to the EBITDA margin percentage as well, because you don't have to add as many people to keep up with the revenue growth and the top line growth of the business.
Of course, regardless of what megatrend is in play, if you can't find someone who owns a BPO to sell it to you, then from the perspective of a lower middle market entrepreneurship through acquisition searcher, it kind of doesn't matter. So maybe Anthony or Dustin, can you talk about what are the seller dynamics at play, and who are the people who have founded these lower middle market BPO companies, and why would they sell to a searcher?
I think it is very difficult for a searcher to find a $5+ million EBITDA BPO business that is willing to sell at a reasonable multiple. More often what we see is $1 to $2 million of EBITDA with a seller that has really enjoyed providing the service that they're providing to their clients. They may be a former accountant in the kind of outsourced accounting and finance space, but they really lack the business development skills to really take that business to the next level. That's the typical dynamic, right? And oftentimes what we see when we come into those businesses is we're able to professionalize the sales and marketing and the business development function to really accelerate the growth of a business that's already created a really good mousetrap or really has a very, very solid product, but really was missing the go-to-market function and the professionalism that's required to be able to sell effectively into the broader market space, or as Conor alluded to, kind of a fragmented TAM opportunity.
I'd love Conor's thoughts there because I think he sees a lot of these folks. But for myself personally, most of these are founders, to Anthony's point exactly, that have pivoted. You know, they started out as a CPA or a bookkeeper, and slowly but surely they started getting asked for more services from their competitor. They were in an on-prem environment doing consultative services, and slowly but surely they don't use ARR as a terminology, and most of them don't even have contracts. So being able to go in there and kind of professionalize the contracted relationship and the service offering instantly creates value, right? Because you got staggered contracts, longer contracts, step function, CPI on the pricing, all these things that at the core, the relationships are really, really strong, and you're building around those core relationships.
Yeah, and I agree with all of that. And typically they have a CPA or bookkeeping background. They kind of fell into it, for lack of a better term. It's word of mouth amongst the referral base. That's pretty much it. I mean, there's very little effort on the front end, and they built a nice business. They've cash flowed, all that's great. But I think like a lot of these businesses, there's a ton of low-hanging fruit right out of the gate in terms of sales and marketing, adjacent markets, expanding the industry reach. Sometimes they have an industry focus, and it offers some nice low-hanging fruit out of the gate.
A question for anyone: is this a buy and build play?
So the short answer is yes. I do think that this is an attractive area for a buy and build strategy, but let me offer a couple of caveats. We are always very wary of buy and build strategies for first-time CEOs. And it is easy enough to do one deal and to, successfully get up to speed on that business and integrate yourself into that culture. It is incrementally difficult to do more than one, right? And there are levels of integration risk that exist with any acquisition within an existing platform. And so we are always asking our searchers, if you're buying a business, is this a platform? And can you earn a reasonable level of return if you only did this acquisition? Now, these businesses often exist in fragmented spaces where there is an opportunity based on the number of targets available in the marketplace to pursue a bolt-on M&A strategy. But we very rarely want to underwrite that as a component of the value creation strategy that is contingent for us to get to our ultimate returns. That said, if you have stepped into a business and you are 12, 18, 24 months in, things are going well, there's an attractive opportunity for you to acquire another business, let's take a look at it, right? And that could be a very viable path to grow. Now, there are a couple of elements that in underwriting we always really try to focus on. The first is the business that you're acquiring complementary in terms of product or service? Is there an opportunity for upsell, cross-sell? Are the businesses on a very similar tech stack, which could reduce the integration risk of acquiring that business? Are they in similar geographies? It is, very different to buy two businesses that are both in Minneapolis than it is to buy one business in Minneapolis while the other is in Southern California, right? At a high level, it's got to be synergistic to the base business. We don't want you buying something that is completely outside of the scope of the product or service that your platform is doing. And so, you own an accounting and finance business and you're buying an HR or outsourcing business. It's a different skill set. It's a different product or service. They have different kind of go-to-market strategies. We would probably frown upon taking that approach.
And yet we still tried to do that at Pro Service with Pro Accounting and failed miserably. There's hubris everywhere.
Well, we're going to be dedicating a whole episode to failures, but in this one, let's talk about industry verticals. Very briefly, before we go to our next sector, can someone talk about sort of the exit opportunity? Who would be a likely buyer for a lower middle market BPO that has been given an upgrade across a number of functions and is ready for a more sophisticated level of operations?
One of the elements that I love about the businesses that we buy is that they are small enough to be in an area of the market that we can buy at materially lower valuations than true middle market private equity players. They aren't large enough, candidly, to garner a lot of strategic interest, right? Our average entry multiple for our fund has been about 6.2 times for EBITDA-based businesses. But we know that middle market private equity's willingness to pay is low double digits as a starting point, right? And so that offers a lot of downside protection and a lot of upside optionality for us at the time of exit. And within our portfolio, we have seen exactly that. If you are able to take a $1 to $2 million EBITDA business and grow that to a $5 to $10 million EBITDA business, the opportunity for multiple expansion or arbitrage on your initial purchase price is significant.
Yeah, I think that's right. I mean, multiples probably 5, 6, 7 times when you're talking about a sub $3 million EBITDA company. To Anthony's point, once you get to that 5 million plus mark, they really kick up into double digits, low double digits. And again, that's a pretty good return story, and there's a pretty big market in terms of buyers out there once you hit that 5+ mark.
I mean, and quite honestly, we encourage our searchers to find a business, grow that business, and then find a middle market partner that's already begun that M&A strategy and that is going to buy that business because it's accretive, and possibly put those individuals in a leadership role in the next tranche of capital that comes in, because they're more set up and more sophisticated in that capacity to do that strategy.
Conor, let me ask you, because I think there's a related reality here in terms of the financing available at $1 to $2 million of EBITDA relative to what's available to a buyer at $5 to $10 million of EBITDA.
So it certainly matters in terms of the size of that EBITDA level. Sub 2 million is going to be more challenging. It's just less margin for error. These are typically asset-light businesses, so that's really what you're hanging your hat on. You have a 15, 20% deviation from plan, and you're at $1 million in EBITDA. That gets pretty dicey pretty fast. So we really look for 2 million as on the lower end. Certainly, we're open-minded and flexible at 1.5 to 2 if it checks a lot of boxes. You're going to see multiples more like 2.5 times on a $2 million EBITDA company. You could probably push that closer to 3 times if it's 5 million plus. It's just a more mature business. Multiples will jump up from a leverage standpoint as well as a valuation standpoint at 5 million plus in EBITDA.
If you're able to grow that business, you're able to get pretty good debt terms if it's got good contracted and staggered contract and low customer concentration. Lenders, I'm not going to speak for Conor, but do like BPO, right? Because it's business services, it's a critical service, it's differentiated, and it's got good recurring revenue, right? So it's as close to ARR as you can kind of get while not being ARR driven. Then bringing in one great new CEO that sits in there with a great board, you can get better leverage terms there than you would in a more traditional lower middle market businesses.
Let's take a quick break to learn about a financial and wealth advisory firm that you should consider if you want to succeed in the entrepreneurship-through-acquisition market, Boulé. Since 2005, Boulé has been committed to the search fund ecosystem, working with hundreds of ETA entrepreneurs across North America and Europe. Its unique tenure in the ecosystem means Boulé are uniquely positioned to partner with you across the entire life cycle of the ETA process. Even before the LOI is signed, Boulé is your trusted partner, offering guidance and discussion points as you evaluate an opportunity. Boulé can lead your quality of earnings due diligence, giving you and your investors confidence that you're buying what you agreed to buy. Post-acquisition, Boulé remains at your side with assurance readiness services and assisting with financial and tax reporting or other consulting needs. Wherever you want to go with an investment, the friendly, trusted advisors at Boulé will help you get there. Look for commentary from Boulé experts in coming episodes of Search Party. Okay, now back to the episode. Why don't we move on? Our next industry vertical that we are going to discuss in the lower middle market is commercial services. Maybe we can throw the first question to Dustin Sellers from Next Coast Legacy. What is the mega trend at play in commercial services, and why is it particularly attractive within the lower middle market?
Two reasons. One, it's a large segment, right? And you've got a lot of lower middle market businesses that are regional. They haven't expanded. And it does connect to some extent to the BPO piece, where more and more facilities and more large retail chains, hospitality, are looking to outsource commercial services, whether that's HVAC or whether that's facilities management. It's not an easy space, so that's kind of nice, right? Restoration is an example where middle market's really gotten excited about the restoration space because of changes going on with climate and insurance and the likes. What's humorous is that a lot of searchers have run past commercial services, right? It got very exciting to talk SaaS and to talk vertical SaaS and horizontal SaaS and just SaaS. And yet digital transformation technology are still playing out in commercial services as well. And all of those efficiencies, if you're good, can be pushed down to the operations to create better margin there, while at the same time finding a fairly boring business that's, doing air-conditioned maintenance. What's funny is the middle market has rediscovered it. Searchers are just now starting to rediscover it.
Anthony, Dustin mentioned that a lot of searchers are running past commercial services. Why would a searcher avoid this sector? Is it lack of experience? Is it they think that the mega trends aren't going in their favor? What do you think?
I think it actually might be a less sophisticated answer than that. And some of it might just be the types of services that they're providing and their attractiveness or interest in the business, right? And so you think about cleaning services being provided to a local school, or you think maintenance repair of air conditioning. To some folks, it's just not that interesting, right? Of a business or a business model. They don't resonate with that type of company in the same way. Despite it having very attractive kind of underlying characteristics and a financial profile, there is less alignment between that particular business model and what they want to do or the type of business that they want to run. If you compare that to a software business, which is an area of the market that we've seen significant growth, it just doesn't resonate in the same way. And therein lies in the chance to buy a business that may be less competitively bid on.
Conor, from a lender perspective, as you are looking to underwrite commercial services businesses in the lower middle market, what are you looking at?
We're certainly first going to focus on the customer base, as in the mix of residential versus commercial. We prefer commercial. That's just a stickier customer base at its core. There can be a mix of residential. Let's talk about landscaping, for example. That'll come with, recurring maintenance contract. Those are pretty healthy. Those are pretty attractive. Residential, conversely, you're going to see higher churn. I think there's certain geographies where you've seen some nice growth with a residential, high residential mix. How capital intensive is it, right? What's your working capital need? What's your equipment need? What's your cost to replace that equipment? Another one is labor, typically some high turnover. These are low paying jobs, blue collar jobs, buying these at very moderate multiples, $1 million or less than EBITDA, and rolling them up to the, 5 million plus that we talked about is a pretty attractive story. And we're seeing more and more of those pop up, particularly in 2024. And, from a lender standpoint, don't have an issue with that. You want those to be methodical roll-ups.
Nextcoast does like an M&A strategy if the platform that they've bought, they've been able to do digital transformation, put Service Titan in, create real good time and attendance solutions for payroll management and labor management, understand their labor burden. That's all real flexible stuff that you can flex on, that you can buy accounts very quickly and immediately create better margin and two, a better service offering and probably solidify that client relationship better because now you've given a better overall experience. What's great about that is you're buying those businesses at like 2.25, 2.5, sometimes, 1 times cash flow. And that's usually very regional. Anthony talked about that before. We don't like to see somebody buying in Charlotte and then deciding to buy in Florida. And then the last piece of the puzzle is trying to minimize fleet. Fleet is, having been in a number of businesses with fleet sucks, right? You gotta store these things and you gotta put them places and they break down all the time. So when you're thinking about commercial services, like I go back to HVAC, commercial maintenance, it's pretty low tech on the fleet side. And you've got one individual that can hit 5 or 6 different locations with one van, and they outsource any of the parts replacement to somebody else. That's usually the manufacturer. So you want to just be thoughtful about for that from a CapEx and just from a logistics standpoint.
Who are the owners of these commercial services businesses? You know, we talked about HVAC, we talked about maybe cleaning services. Paint a picture of who they are, what their goals are for the company, and what their reaction is when a searcher knocks on their door.
I mean, I think that the profile of commercial services business owners looks very consistent with the BPO providers that we talked about before. They're often someone that actually provided that service, right? Like they have a intimate knowledge of how to perform that job function because they actually did it before, right? And they may have fallen into an opportunity to take over the business that they worked for previously. They may have had a customer that wanted them to come in and provide that service at a larger scale across a wider group of their existing facilities. And, you know, sometimes often built a business by mistake. Similarly, they often struggle with growth and go to market, right? Most business owners that have an intimate knowledge of how to perform a service really well because they did it before are likely not as sophisticated when it comes to sales, marketing, and business development. It's just not what they know. And so that's really one of the primary opportunities that we see when we acquire those assets to come in and really professionalize that type of go-to-market value creation strategy.
I think Anthony makes a really good point, is that the good searchers, the great searchers that we work with, get to know the industry, they get to know the space, they get to know the regionality, they connect with the owners and assimilate themselves into that industry before they go out and they call Chip and they call Steve and they call Wendy. They understand the KPIs, but they're not talking about them as KPIs. They're talking about the changes going on in, hospitality landscaping and what kind of inflation has been doing on minimum wage in the state of Florida. Like that kind of stuff to a business owner goes, oh, you actually are paying attention to my industry. And that matters a lot in the lower middle market and especially in commercial services because it shows that you understand the complexities because they know their business intimately. And it's a mistake searchers make all the time. These people are experts. They don't have a book written on themselves, but they are experts in what they do.
Dustin, just sort of follow up on that. How do you think a traditional search fund acquiring these types of businesses differentiates from private equity? Do you think that resonates with these sellers?
100%. I mean,
Yeah.
Anthony, maybe you want to opine on this because this is your soapbox. Yeah, I mean, that connectivity, right? The reason legacy is in our name is we are not private equity. We don't want to talk private equity. I don't even understand what that means. We're talking about legacy. We're talking about what you've built. We're talking about this great business that is a family member. We want to see that and flourish that and grow it.
Yeah, the value proposition of search kind of at its core is the transition of the legacy of a business owner to someone that wants to come in and run the company. And that often resonates with owners because that's their baby, right? They built that business with their bare hands and they cared about every employee that they hired. They don't want the business to, have a story of failure on the other side of that. And so they want to know that the next owner that comes in cares as much about that company, about the employee base as they do. And a searcher's ability to build a unique relationship and to be able to articulate their values in a way that a business owner can have confidence in that is really important. Look, we're often not the best bidder or the highest buyer for these assets. A business owner sells to a searcher because they believe in the individual. Yes, they want to be paid for their company, but it's about more than just the money that is resulting in their willingness and their desire to sell to a searcher versus a private equity firm that might be able to pay a higher multiple.
Why don't we go to our next industry vertical? It's a big one. There's a saying, I think, from Mark Andreessen, which is software is eating the world. Now that software has been around for quite a while, actually, it has made its way down to the lower middle market. And there are software businesses for sale in the lower middle market. Maybe we could start with Conor. Have you seen a steady increase in software deals in the lower middle market? And what does it look like today?
It was a hot space. It is a hot space. It'll probably continue to be. I mean, it's it's a very general space, but it's everywhere you look. And you said it, in the lower middle market, it's no different. It touches every industry. From a lender perspective, why we love it is it's stable, it's predictable, there's a lot of revenue visibility. And typically when they're of scale, we're talking about even, cash flowing and ARR above $5-6 million. These are critical software applications. So they typically come with high gross retention. We're in year 11 of search fund lending. I'd say that's the space that we started in. It was probably, the safest, if you will, and we've continued to grow it, continued to be active in it. Certainly it's where you're going to pay the most as you move up market. So you want to be conscious of that.
Yeah. So software is a power alley for us. It's an area of the market that we love. It has a lot of underlying characteristics that are consistent with that of the types of business services or EBITDA-based businesses that we acquire as well. If you go back 10, 15 years, I think the common refrain from investors in the ETA space was avoid software at all costs, right? And it introduces complexity and risk. But what has materially changed is you can't avoid software. It is very hard to find a business, to find an industry that has not been infiltrated by software, or where software is not a core component of the service or product delivery mechanism for a company. And so we lean into that. And rather than avoid the software, we try to create or form a set of key criteria that we leverage in our underwriting that we can be comfortable with. At a high level, it's recurring revenue. Well, most software contracts are annual contracts with auto renewal clauses and price escalators. They have very high degrees of recurring revenue. They typically are mission critical, which produces stickiness and results in, as Conor alluded to, really attractive retention profiles, both from a logo retention and from a net revenue retention standpoint. And from a margin standpoint, you have to look at it at a gross margin level versus the EBITDA margin line. But when you have a company that has 70+% gross margins that's growing at a reasonable clip with very good LTV to CAC ratios, you have a high degree of confidence that as that business continues to grow, that revenue growth will accrete to the EBITDA line, and you should start to see expansion in EBITDA at scale for software businesses, just given the degree of leverage that exists in the business model. And so we really orient our searchers to focus on a lot of those key characteristics: 70% plus gross margins, logo or gross retention in excess of 90%, 100% plus net revenue retention. We want them to be positive on the EBITDA margin line at the time of acquisition. For us, we want to reduce the future funding risk that comes with investing in businesses that are burning cash, right? And if you're wrong in any element of your underwriting, the likelihood that you're going to have to put more money into that business quickly to be able to foster that growth is very high, and we want to avoid those situations. And so this is a very different type of investing than exists in a venture capital context, right? We are investing in self-sustaining, profitable businesses in a particular niche of the marketplace, said differently, vertical software, with TAMs that are less than $1 billion. We're not looking to grow and build billion-dollar businesses here. We want to buy nice little software companies that have some differentiation of product or service, most consistently represented by building a product that caters to a very specific subset of customers, whereby, assuming reasonable penetration, we can still grow a reasonably sized business, but we're not trying to buy or find Google, right?
We're out in the marketplace talking to searchers and potential searchers a lot. And the refrain is always, well, gosh, everybody's looking for that now. And it's so much harder than it ever was. My pushback there is there's a lot less consolidation than you think that's occurred at this size of the market. Those owners have definitely been pounded by Grata emails, but they haven't talked to many people. So actually creating connectivity and finding your adjacency to the area that you started looking and getting smart there and getting the connectivity in the space goes a long way. We're still seeing great deals getting done at great multiples, but those searchers have gone the extra mile. They've really spent a lot of time in an area and gotten very, very smart there and been able to win over those founders who, weren't looking to sell per se, but really like the storyline that searcher's brought to the table.
In addition to lower middle market ETA searchers, what is the universe of buyers looking for these businesses right now? I know it's more competitive, but when a searcher shows up to knock on the door of the owner of a smaller software business, who else has been contacting that owner?
Yeah, I mean, look, let's not gloss over this reality. Acquiring a software business as a searcher is harder. It is more competitive. And by virtue of paying a revenue multiple for a company, you start to get into an enterprise value range, which makes that deal possible for a larger group of investors. True middle market private equity players can step down into this range of the market when you're paying a revenue multiple. And they have a different cost of capital embedded within their underwriting. And so as a result, they can pay higher multiples, right? And so it is more difficult, without question, for searchers, I think, in the current environment to acquire software businesses. To Dustin's point, that doesn't mean that you shouldn't attempt to acquire a software business. But I do think that there is a greater emphasis on thesis development. There's riches in the niches, right? And so being able to find a subset of an industry that hasn't been as picked over, that might have alignment between kind of your background and your professional experience that makes you more uniquely qualified to acquire and run that business, there's an opportunity there, right? To connect with a business owner. They care about their employees. They care about the business that they built. They want to see it transition to steady, confident hands and someone that they believe has a real desire to run and manage that asset.
And the funny thing, David, there's this assumption that, okay, commercial services, that's blue collar, so I have to put a different hat on there. BPO, CPA, I'm going to put a different hat on there. It's very much, you're hearing from Anthony, the same narrative, which is this person had authority issues and didn't want to work for the corporate environment, or just didn't have the opportunity to, and just found themselves in a business, grew it for 30 years. And so how you connect with them is almost irrelevant of all of these different verticals that we've talked about.
Does the background of the searcher matter more in the software sector? Is a software background essential for success in finding a software company owner willing to part with the asset?
I would say no. But there is an element of this that's a reality in that for most searchers, they don't have a coding background or come with a degree of technical or engineering skills, right? And so fundamentally, if your CTO leaves, you can't step in and provide that service, right? And so I think from an underwriting standpoint, you have to be aware of where the failure points are and who the key personnel are as you're going through the underwriting process. Optimally, if you can buy a software business that has a really well built out product already, where there's not a lot of future product development that's required to build a mousetrap that people want, and all you really have to do is step in and professionalize the business development side of that company, that's a great place to be, because that's probably what the searcher's good at, or at least something that they can get their arms around and they can add value in. If you don't come from a technical background, you can't add value in the engineering or the coding aspect of that business.
I'd really love to hear Conor's view on this, because it's one of the areas that we've pushed back the most, is the danger with the searcher that they want to be the rock star, right? They've got ideas of all of these adjacencies and how to increase the wallet share of the service profile, not really understanding what the life cycle is of the product and what it really takes to actually build out a new module or do different things. I do feel like searchers consistently underestimate that and or haven't done the level of kind of tech stack diligence needed to ensure that they don't have tech debt coming in their future.
A big part of our underwriting, specifically with this industry, is key employee retention, to Anthony's point. I mean, these aren't huge businesses. They don't have an army of engineers. Whoever is the engineer or engineers, they're going to be pretty critical to that business going forward. So what's that retention plan post-close? What are the gaps of the searcher and how are those getting filled with the existing team? Or conversely, what's the plan to go higher? So we dig into that pretty hard. We lean on folks like Next Coast. They know these searchers better than anybody and what their gaps are and how they're going to fill those. You got to have that CTO engineering suite fully proved out. And if not pre-close, you got to figure it out post-close pretty quickly.
I don't know. Conor, maybe you want to talk a little bit about kind of change in multiples.
Yeah, it felt like they were getting somewhat out of control there for a while, and they are coming down a bit. For us, we're still cash flow based lenders. So a lot of these software deals, the perfect mix is healthy EBITDA with healthy ARR, which isn't always the case. I mean, Anthony and I talk about this. You guys see deals where, it's not a bank fit because cash flow is marginal or it's going to be on a J curve post close. Those deals with the healthy cash flow and the healthy ARR, those are still garnering, pretty healthy multiples.
The most material change that we have seen over the last 3 or 4 years, specifically relative to software, has been the increased focus on profitability. To Conor's point, gone are the days in search, at least, or an ETA, where you can buy a business that is growing at 40 to 50%. You're very conscious of rule of 40, but there is also a balance that has to exist between growth rate and profitability. And so if it is a 40% grower with 0% EBITDA margins or negative EBITDA margins, that's a hard deal to get done. And the market's willingness to pay for those assets has decreased, right? We've seen that most evidently in the public markets, where there's been a large bifurcation between profitable and unprofitable software companies as we've seen growth rates decelerate. And so if I look at the deals that we did in 2023 in software specifically, our entry multiple from an ARR standpoint was actually probably consistent with 2021. But what changed materially was the EBITDA margin of those businesses that we acquired at that same average entry ARR multiple. And the EBITDA percentage is almost triplet, right? And so there's been a very intentional focus in our underwriting towards that focus on profitability, and making sure that we're buying sustaining software businesses whereby if you see higher churn, if you see some degradation in the revenue growth of the business, you're okay and you don't have future funding risk.
I think the only last thing I would say is on more of an international perspective. It's interesting, we don't do a lot of international investing, but we are seeing kind of searchers lean into vertical SaaS and replicate successes in the United States, in Mexico, in Brazil, and in parts of Europe, where there hasn't been the same leveraging of the search model in the lower middle market, but yet the same ecosystems exist.
Excellent. Well, this has been a tour de force of the lower middle market in 3 very important sectors of the market: business process outsourcing, commercial services, and software. There's a lot more sectors out there, and the 3 of you have done quite a lot in those sectors, but I think we'll pause for now. And I look forward to our next conversation about what's going on in the lower middle market and the opportunity for ETA going forward. So thank you, Conor Tidgwell from Avidbank, Dustin Sellers and Anthony Walker from Next Coast Legacy. Search Party is sponsored by Avidbank, Boulay, Mayer Brown, and Plexus Capital. The lead sponsor is Next Coast Legacy.